Our guest this week is Rick Zullo, founder and managing partner of Equal Ventures. Equal is an early stage venture firm based out of New York that takes a concentrated approach with investing themes around climate, insurance, retail, and supply chain. We talked about why Rick invests with conviction, the state of seed investing, what climate volatility means for insurers and investors, and why being kind is more important than being nice. Please enjoy. Rick, thanks for coming on the show.
Glad to be here. Thanks for having me, Joe.
So you mentioned on Twitter recently a quote that I want to talk about, which is a lot of companies die because their investors would rather be, quote, nice in all caps than kind in all caps with a quote. Tell me more about that.
So I think this concept of being nice versus kind is a really subtle difference in the way that we operate with people. If you're nice, it means that you're polite. It means that you say the right things, and you might say that someone's hair, is, right that day, or you like that they did certain things, even if you didn't like it. It's not truly genuine. Whereas the kind thing to say is, "Oh, Rick, you have something in your teeth. Like, let's tell you that so that you don't run around with spinach in your teeth the rest of the day." Which sometimes the kind thing to do, which is often perhaps uncomfortable, is actually more empathetic because it's in the interest of the individual and you actually hold their interests at heart. Now, there's plenty of cases that you can be a kind and actually be mean or be a jerk about it and say, "Rick, you look like an idiot because you have spinach in your teeth." And there's a nice way to do that in kind. But I do think one thing that I've seen in VC versus when I was in consulting or private equity is we often obsess over the NPS score around founder friendliness and around the collegiality, given the long-term nature of this, that I've interacted with investors who have willingly told me that they know that the founder is headed in a wrong direction, but it is not in their interest to tell the founder that they're screwing things up, that they're concerned about the reference check that they're going to get. They're concerned about ruffling feathers. They're concerned about being wrong. And for that reason, against their own interest and the interest of the founders, they let that company die. And they'll pat the founder on the back and they'll be their cheerleader, but they do the nice thing rather than the kind thing. The kind thing, in my opinion, is doing what's in the best interest of the entrepreneur. Ultimately, you should want that founder to have an incredible outcome. We work on behalf of a lot of great organizations that represent great causes. And I want to make sure that we're maximizing the value of our shares for those folks as well. So for better or worse, like, we are unafraid to tell a founder what we feel like they need to hear. And I think that is honestly what the industry needs more of, is more of a focus on helping, being kind in those moments rather than patting someone on the back on the way to their grave. I think the kind move is actually the much more founder friendly thing in the long run if you do it right and you do it tactfully in the right way. But unfortunately, there isn't much incentive in place for folks to do that, especially when people are jumping between VC funds every 2 minutes and raising funds every 2 seconds. They're a little bit more focused on being nice.
Yeah, well, I think our LPs would probably agree that they'd rather us be kind and direct than nice and watch something go into a ditch.
Perhaps, but I think like the reality is like this is a part of the nature of the entire venture ecosystem, is that it's so long dated and it takes so long for the maturity of these companies. And often the incentive alignment isn't there, whether it's LPs not being incentivized by the actual value of the portfolio, the carry that many LPs are not incentivized in that way. They're incentivized in various other ways, which lead them to actually, I was at an event the other day where the LP unapologetically said, is like, we want to invest in nice people. And I think we'd all like to work with and be with nice people, but I clicked into that as I was thinking about this statement, which has been something that we talk about a lot. And they want to be with the investors that are everybody's friend. And I think that's great. I want to be everyone's friend too. But at the end of the day, we also want to make sure that we're representing the founder and making them the best that they can and representing our LPs and getting the best outcome for that. And I thought about that in a relationship to, I'm in a peer circle with a couple hedge fund private equity guys. And they're like, we don't think about for a second of our day about being nice. Like, it's like, how are we making money? And so I think very often the VC and LP dynamic is very insular. It's very focused on like which social circles rather than like who's making money and who's having great outcomes. And I think that's because like the math is always pretty fuzzy around these companies. You could have a 3 million ARR company worth $1 billion, and in other cases, a 300 million ARR company worth less than $1 billion. And that's the way that we all have to navigate this ecosystem. But at the end of the day, I think we all need to be able to rest our heads at night and I'm thinking about what we're comfortable with. And I think, yes, we always want to be nice people, but at least from an ethos perspective, I think we'd all be a little bit better off if we focus on that true level of empathy, that kindness of making sure that we're doing what's in the best interest of everyone rather than just kind of the politeness factor of it. But maybe that's my middle-class Jersey roots that I just can't prevent myself from saying what's on my mind. So,
no, I like it. You've probably seen debates that pop up on Twitter or LinkedIn or X now and again where founders will lament not getting feedback from VCs. And occasionally VC will stick their neck out and say, it's because there's not really any incentive for me to give you feedback. Where do you fit on the continuum of giving feedback to founders?
So I think you want to give feedback where it's actually wanted. So the reality is there are plenty of founders that don't want that feedback. And personally, I've gone to the point that I actually take very few founder meetings at this point. I'll throw this back. How many meetings with net new founders do you think I take per week?
I know you're pretty concentrated, so I'm assuming it's a few.
Give me a number.
I'll go few. I'll give you 5.
Okay. There are many weeks that I will go an entire week without meeting a single net new founder. And so I may meet 30 to 40 companies per year, maybe even less than that. And that still leads to us doing 4 or 5 deals per year, which 5 of the last 6 deals that we've done have been with founders who have started billion-dollar companies before, started and built billion-dollar companies. So our lens is extremely concentrated on that. And I do think, given the nature of our strategy, it's finding the right fit for the founders that we like to work with. 2 of those folks are founders that I've worked with before who have built gigantic companies. And I would say those 2 folks are 2 of the most active people in asking for feedback. That here we are. I've already spoken to 4 of those 5 founders today, and we're in the early afternoon here in New York time. And one of the quotes from one of the founders that he had at our last AGM, when he had his first company, which went public, he said he probably wouldn't have been as willing to take advice from VCs along the journey because he would have been worried about what people were thinking and whether it was a signal of strength and whether it showed what he knew what he was doing and so forth. And then on this next go, as he built, his next company, he's actually wants as much feedback as possible. He treats feedback as a gift. And I think that is going to position him to have an incredible company, provided that feedback is coming from the place of alignment, as well as we very much focus on the prepared mindset of actually having informed opinion. I think there's plenty of VCs out there that give uninformed opinions, that they will go and sometimes with their own portfolio companies talk about something that they actually do not have a prepared mind on, and that they're layering on the perspective of the hundreds of other companies that they've had to a very particular circumstance with this company. And that's one of the reasons why founders may have an aversion to getting feedback when it's coming from a place of misalignment, when it's coming from a place of being uninformed, which, look, there's many different ways to do this business, but for better or worse, I think that when we talk about a partnership, that's the way that we want to treat every investment that we do, that we want it to be symbiotic, that we want to find a way that we can add value to these companies. And we want founders who actually value the feedback. And, you don't want folks who need you 24/7. These have to be incredibly strong founders in their own right. But I actually have found that over the years, the strongest founders are the ones that have the most confidence in themselves and the most ruthless addiction to how can I get better. That whether it's a first-time founder or an experienced founder, they are folks who crave feedback, provided that they trust you, think that you're informed, and think that you're aligned in terms of the right outcome spectrum with them. That if you can bring those things to the table it can really, really be beneficial to a founder. But if it's a founder that doesn't want to hear that feedback, you're speaking to dead air, and you're more than likely going to have a situation where someone's getting pissed off at you, like on Twitter. Yeah. And, I don't know. I've certainly had that happen. And that's just as we decide which founders we want to work with, then I get a little bit more surgical on who I want to spend my time with. I'd rather spend my time with an incredible operator who has a ruthless addiction to getting better, and working with that to help that person go from being 99% to 100% is a more enjoyable way to spend my time, but hopefully for myself and our LPs and that founder, a more lucrative way as well.
I'd like to go back. This is kind of wonky process thing, but this feels like good wonky process discussion. To go back, you'd mentioned you might go a week without talking to any net new founders. How do you, and on your site, you've got 6 investors, I believe, working with you. How does that flow, like the meeting flow, work through with you guys? And I'm selfishly asking because I recently did my annual letter, was looking at my own metrics around meetings per deal, and it seemed high, and not high in like a bragging kind of way, but I wondered, am I doing too many meetings? Like, should I tighten the number that I'm doing here to get to what feels like an optimal number for my strategy? So I'm curious kind of how you approach that organizationally.
Yeah. So we have 3 different types of profiles within our firm. Now, like, I'm managing partner, and I operate in many cases as a board member, CEO, and CIO. We have generalists in our firm who do not have an industry specialty, and they are largely meeting with what is the deal flow that's going around, operators and founders who are considering starting companies, but nothing particularly around a given sector. And then we have what we refer to as our product owners. And our product owners are responsible for sourcing, servicing, and researching within the sectors that they operate in. That is insurance, energy, supply chain, and retail. And all 3 of us approach sourcing and that deal process in very different ways. But we actually, as we are looking at investment opportunity, part of our process is that actually a product owner, a generalist, and myself are involved on every single company. So it doesn't matter where a deal comes in. It could be Ali from my team talking to someone at General Catalyst. Hey, have you heard about this company? Why don't you meet them? Or a founder that he's had a relationship with for being in the venture tech ecosystem for the last decade. It could be I have a founder that has had a big outcome before that I've had a friendly relationship with, who decides that he wants to talk to me and says, hey, I'd love to meet your team and help me kind of research or formulate this idea. Or it could be one of our product owners finding a diamond in the rough, something that is an idea or thesis that we think we have a lot of enthusiasm around, maybe sent to us by one of our customer partners in that industry, but it's someone who's never started a company before, maybe someone who's never even worked at a startup or in tech before. And the process for those 3 different founder profiles and how that deal comes in is going to be very, very different. That deal process is going to be very, very different. So largely my role in the firm, especially as I've kind of proved myself a little bit back, to encourage our product owners and generalists to deal more with like the traditional sourcing methods and finding kind of outbound sourcing opportunities within our theses. I'm more doing kind of like partnering with founders that I've had decade-long relationships with, or folks who are kind of considering their next act, and helping bring them into our firm. But I touch every single deal that we're involved with, as does everybody on our team. We make sure that we hunt together as a team, that there isn't a single deal that we do that not every single person in our firm is meeting with. So I think we've had deals get done in as little as 5 days. I think we issued a term sheet to Ghost 5 days after a meeting. That was, I had known Josh Kaplan, one of the founders, for 10 years. At that point, they were pursuing something that was dramatically in alignment with the thesis that we had. The company, when we initially met it, like, I'm not even sure, it had a different name, and it was no product, no anything, but we got to term sheet in 5 days because it was an idea that we really loved. It was a team that we felt was really incredible. And that's been a tremendously successful company for us. And then there's other cases where we wired on an investment today. I have known the founder for 10 years. We've been talking about a concept together for 6 months. And then we finally got the term sheet on it last month with him. And that's a great way to do that as well, where myself and Adam and Ali on our team have been meeting with this company weekly for 6 months prior to wiring a $3 million investment today. So I think there's multiple ways that we can get there. The reality is, I think it's really dependent on one, the profile of the investor. Like, I'm not going and doing a lot of outbound sourcing at this point. That is how we stumbled upon companies like Free Flow, which is another great one for us. That is mostly what our hunters are doing. We're not responding to a bunch of inbound deal flow, or at least I'm not. That's what Ali and Sophia on our team are. Yeah, I get to do what I think is the most fun part of the job, is working with these folks that I may have known for a long time because I'm like a geezer in this business now, and bringing them into our firm, helping them kind of formulate an idea, but also helping us usher along those diamonds in the rough, or helping us win a deal that's in a competitive process that we're ultimately not going to go and say, hey, this is a one size fits all approach for every single deal that we have. We want to make sure that it's specific to the individual and specific to the company.
You mentioned a blog post late last year that Equal spent a lot of time thinking about climate volatility in insurance. And I thought that was very pertinent for, unfortunately, what's been happening in LA. How do you think about, well, one, I'd like to get you to roll a little bit about the process around that and just kind of your approach to Prepared Mind, and then kind of flow into what you learned from the digging there. And maybe question 3 with that, just to throw too much at you with one question, how you think about what's happened recently fits with that thesis.
Well, let's talk about that part first, because what's happening in Southern California right now is truly tragic. And what's even more tragic is it's not the only place in the country right now that we're seeing catastrophic climate-related stress happening. So look, we have snow in Florida right now, in Panhandle, Florida, at the same time that we have wildfires raging in California. So the reality of the situation is there's losses going to be experienced on both sides of the spectrum, losses economically as well as tremendous loss of life. So the reality is, like, believe it or not, climate is impacting the way that we live, and it's going to impact these weather patterns pretty dramatically. Losses on the property casualty side are obviously going to be incredibly high, but think about business interruption and so forth. That I haven't gotten an early read on this, but if there's frost in Florida, I'm not sure if you've ever seen the movie Trading Places, where Randolph and Mortimer, they talk about the frost of the orange and how it sounds like orange futures taking back and forth. So the reality is, like, yes, there's property and casualty risk. There's also tremendous business interruption risk that the climate is going to have incalculable impact on all facets of our life because the damage that we've done. And for better or worse, one of the biggest industry's impact from that is going to be insurance. And I've spent the entirety of my career climate. I was an energy guy and clean tech guy before I was a generalist tech investor. And probably the sector that I've spent the most time investing in over the last 10 years is insurance. I've probably been on the board of 7 insurance companies or enabling companies in the sector that I really love. So as we could kind of start seeing that escalate and pop up from a couple of different angles, and we can dive into more of what our research process and how we develop a prepared mind. We put out an article kind of outlining some facets of our process just a couple of weeks ago. But I said, these are 2 of our 4 themes. Like, if we're not winning something at the intersection of climate and insurance, then like we did something wrong. So we spent a lot of time with folks in our industry networks, and one of them happened to be the chief innovation officer of one of the largest insurance companies in the world, and asking them how they felt that they were going to resolve and kind of make themselves ready to deal with all the impacts that climate would have on their clients. And frankly, they were at a loss. They were dealing with vendor fatigue. They were dealing with a litany of different systems that didn't speak to each other. And for better or worse, everything in insurance is a multi-party transaction. You have reinsurers, you have brokers, you have carriers, you have fronting agents, and you have a bunch of TPAs involved. To actually get change in an industry that's several hundred years old, you need to figure out how to not just change one behavior. You got to change all of it. And that, frankly, is an impossibility in today's environment, which is the reason why we ultimately came to the conclusion that if we were going to play the space, it had to be an incredibly big swing. We weren't going to invest in a widget or a tool or a product. We needed to invest in something that we felt could actually be one of the category defining companies of that industry. And to do that, we spent 2.5 years doing work. we spent a very large amount of time meeting and looking at companies. And fortunately, we were able to meet Dan Preston, who was CEO of Metro Mile, took that company public, and he assembled a team that is frankly one of the most impressive teams that I've ever seen in my career in terms of him partnering with Sam Shang from Hotel Tonight, obviously a tremendous exit to Airbnb, Bill Clerico from WePay, tremendous exit to JP Morgan. And, so he's a volunteer firefighter also in his free time. He's just someone who's very deeply passionate about it, runs a fund called Convective Capital, really focused on climatic risk. And Jason Mueller, who happened to be actually the boss of one of my colleagues back when they were at Policy Genius. He was chief product officer there. I mean, we knew that if we're going to do something in this space, it had to be fully vertically integrated. It had to be something that could change that behavior, unify that behavior, and bring enough of that under one single roof to be able to actually make this all make sense. We just weren't super confident that there was going to be a team that was strong enough to do that. I mean, you have to raise a lot of money at the gate. You have to get a bunch of really incredible people to believe to even bring a product like what they did to market. And developing our thesis, we were fortunate to think about this several years ago and do hundreds of hours of research to arrive at this conclusion and be able to find some willing partners that wanted to see what we believe could be possible coming to fruition. But it's terrible to see, what has happened in California. And I'm really hopeful that as we think about what is going to happen with climate volatility moving forward, that we can align behind resilience. And I think that is really at the core of what our thesis is around the sector is we're not going to be able to change climate. There are certain people who believe more in aspects of can we suck carbon out of the environment and do all this. I think we're at the point that hundreds of billions of dollars are going to be lost every year unless we find ways to adapt. And the only way that we can do that is through resiliency. And honestly, we think that the insurance sector is one of the best ways to do that by finally incentivizing outcomes, which if you look at where floods happen, they always happen. Florida's flood plan, I believe it's 80% of the losses are places that have previously been destroyed in the last 10 years. So we're going in and doubling down because we haven't found ways to align incentives to have people make the responsible decision to build in ways that would prevent those properties from flood. If you look at what we do at Stan, we find ways to make sure that we're not just underwriting risk that are the right ones that we think are where the fire will reach, but actually looking at here's a rose bush on your property. Here's what the cost of that is from a risk perspective, because that rose bush, whether it's 5, 10, 15, 20 feet, we can actually predict based on simulation how much risk that will put in terms of spreading wildfire. I can tell you, my wife is a real estate private equity investor and developer. Their firm has seen insurance rates go up every single year for their properties in California and elsewhere, despite them doing really bleeding edge work on reducing the risk of and improving the resiliency of their property. And it's because insurers do not give them credit for everything that they do, because that is not the way that the insurance industry is built. So we felt that it needed to be rebuilt. And I'm very hopeful and certainly have a high belief that Stan is the company to do that. And we're very much hopeful that we get the opportunity to invest in other companies in climate resiliency that are able to kind of support that narrative.
What does the creative process look like for cooking up the themes for your firm, investing themes?
Mike Maples has this concept that he was like, he believes in finding secrets. And I think I really love thinking about it from that perspective. I think there's plenty of other firms that'll say, hey, we're thesis driven, and they'll put out a market map all around okay, here's AI in the insurance industry or whatever. We want to go landscape all the SDR tools or whatever. And that's fine. In some ways, that is a prepared mind, but I don't think that is the creative
Seems as much
thing.
Marketing as it does.
Yeah, there's plenty of
prepared mind. Yeah.
I will say we've more than once caught one firm literally copy and pasting things from our own research and putting it on their website. I won't call out that firm, but they definitely know who they are. But the reality is that is not the thing that I think provides alpha. I think secrets are what provide alpha. And I think this is the reason why not being a tourist in these industries and making sure that we find information that comes from outside of the traditional startup circles is so incredibly important. So when we thought about what we deemed the inventory apocalypse, that was back in 2019, several years before we met Ghost. In 2019, I was having conversations with research analysts, private equity funds, folks in the retail industry, and I was at a dinner with a bunch of folks, and someone mentioned, like, hey, I'm starting to see a lot of inventory starting to accumulate on retailer balance sheets. Have you guys seen anything like that? I was like, that's kind of interesting. And started pulling the thread of how to go. And ended up sending a bunch of call notes and research through my team. And our process for going and pulling that thread is every other week, we have a multi-hour research briefing that we've put all these call notes together to develop a mass set of knowledge. Literally, our knowledge management system, I think, has like 5,000 linked articles in it at this point, because we're research nerds at heart. And then we discuss and debate these things, and we try to look for commonalities and patterns and so forth. And as I was going in through that process of figuring out why inventory was accumulating on folks' balance sheet, it actually ended up coming from another one of our advisors that we had, helped explain why discounting via digital channels doesn't really work, how it destroyed brands like J. Crew, because once you can go and see that something's 40% off on some website, or you're going to pay full price for those Nikes. So inventory is going to accumulate because discounting is a less viable alternative in the digital age. And we started pulling that thread, developing our point of view, getting a bunch of customers stacked up on both sides. And then COVID hit, and what we thought was going to be the size of inventory doubling over a course of a couple of years ended up being 5-6x over a period of 2-3 years. There was usually somewhere around like $200 to $400 billion of structurally excess inventory. And then overnight that hit trillions. And that ended up creating a massively positive catalyst for a company like Ghost to exist, which that was certainly a non-consensus opportunity at the seed round, and very much through the early life of the company, I think it's a very consensus. They certainly have had a lot of copycats chasing them lately, but I think it was going through that process of doing years of work, years of relationship development to arrive at a secret of, wow, like, why is inventory starting to accumulate on retailer balance sheets? And that wasn't something being discussed amongst a bunch of VCs. It was me getting knowledge from outside of venture circles, from a bunch of private equity folks or Wall Street analysts or CEOs who are managing some of these 3PLs and so forth, which, like, we're all about finding that alpha information.
How do you feel about the state of seed today?
I think it is the worst stage to be investing. And I've been like, I've been very, look, seed is our entry point. It is where we primarily invest. It's where we spend our time. Again, most of the deals that we do are formation stage, pre-product, pre-revenue. That said, I think there's a lot of data that this has been the worst environment for seed investing in a very, very long time. So maybe 2 years ago at our AGM, I showed a stat to our LPs of comparing what late stage valuations were to seed stage valuations. And historically, that premium was about 20 times. So think you invested at a $8 million post-money valuation, then a late stage valuation was 160. In 2021, that number hit about 40 times. So you were seeing a $10 million company, all of a sudden, the average valuation was 400. Most incredible time to be a seed stage investor was that kind of like 2011 to 2020 period where all those companies were hitting maturity, that you invested in something at a 4 pre. Man, I remember when like that was what a seed deal was like a 3-4 pre. Beautiful time. And then 10 years later, every single late stage company was raising at hundreds of millions, if not billions. In 2023 and 2024, and we'll see where the number goes in 2025, that spread has gone down from 40 to about 6 or 7. And so that means that the average late stage valuation has come down dramatically. It's back to kind of the normal range of what it was previously, the 120 to 150 range. But seed stage valuations are more than double what they were back then. They're now in the 16 to 20 range. So when you look at that, you've seen this immense compression between the spread And I think that's largely driven by certainly mega funds are very price inelastic at seed. There's tremendous competition at seed. The late stage environment, unless you're doing something crazy AI, is still very challenging and difficult. And all that makes seed like a very, very hard place to invest right now. So that is what it is. That we are at our heart a seed firm. But I do think that there's more innovation to be had, and some of the best decisions actually are made in like, when do we double down and how do we be the best Series A and Series B investor in our portfolio companies? Because I think it's really, really challenging to make money in seed. And unfortunately, that's where the vast majority of emerging managers are. That I think there's likely to be a pretty big washout there in the next year or two. And that's something that I find pretty concerning, and it's unfortunate.
Does that impact how you think about selection at seed? So, for example, are you more cognizant of capital efficiency there and their ability to keep running without having to raise more?
So I think our mindset on this is play offense and defense. So we want to make our companies that we think do not fit the traditional model of like exactly what the big funds want, as least reliant on venture capital as possible. So we have several companies that within 18 months of funding their seed, they are tripling, quadrupling, and cash flow positive. And that is phenomenal. And one of our LPs says, like, Rick, my favorite company is one that you own 20% of, like goes public and has never had to raise a round. Wouldn't we all love those? I love that too. You don't get any markups along the way, but you get a big pile of cash at the end of the day. And that's what this business is about. And certainly there are some companies that we have that are like that like we would honestly probably take every single round of the company, that like we want them to defray and push off venture capital as much as possible. We have companies that we did 2 years ago that are still not up on our website because like we want them to be quiet, and like we see it funding them, and now they're north of 10 million in revenue. And we love that. And that is one profile of investment that we have. There are other companies that will require a massive amount of venture capital. And to do that, we need to make sure that those teams and so forth are capable of doing that, and making sure that they understand what they're getting into, and they're raising capital in the right way, and making sure that they're not setting up with structure, and making sure that we are formulating and connecting the dots with investors to explain the nuance around a thesis to help them develop conviction and belief in that. And I think both those profiles can work. But I do think it's the land of the lost. And if you're trying to be a capital efficient company, but you can't be capital efficient and you do raise venture capital, that gets you in trouble. And I think there's a lot of companies in between those two spaces that they're not growing quite fast enough to raise the IRA venture capital, but they're not profitable enough to be self-sufficient. And that's a tough spot to be in.
Equal takes a concentrated approach to investing. Was there a eureka moment in your career that led you to think this concentrated thing is for me?
So I think there's really like three phases to this story. And one, like most people would probably find this like an absurd proposition given like what they probably perceive to be brazen confidence on me. But like so much of my investment background and career has been formulated from a place of what I would say is inadequacy and fear. And I think when I stumbled into the investing business, like I didn't intern at Sequoia, I didn't go to Harvard or GSB. Like I knew like very little about actually like I took 2 CS classes at Columbia, and when I was at business school there, and I like nearly flunked both of them. Like I am terrible at the technology side of this business. So when I came in, it was, how am I going to go beat? Like, why would a founder ever take my money? As this punk from University of Richmond, Jersey guy who like barely knows a lick about like true technology. And I wanted to find places where I could find alpha. And that was hard to find. And my belief was doing that in these sectors as technology started penetrating the universe of things that I knew a lot about. I knew a lot about energy. I knew a lot about industrial businesses, and being in a place like Chicago where every single building was named after an insurance company, I started to learn a lot about insurance. You got the Sears Tower, retail too. So you look at these sectors and I could tell myself, hey, maybe I can find a couple of needles in a haystack a year. And so develop this very research-driven approach where that's not the most scalable way to do 25 deals, But for better or worse, for me to get to that level of conviction that I could say, here's a deal that no one else wants to do, but I want to do it because I feel like I had an asymmetric insight. You can't have 25 asymmetric insights, opportunities like that a year. For the entirety of my career, I've done 3 to 4 investments per year. It has been like clockwork. And some years, maybe it's a little up or a little, but it's never been 10 and it's never been 0. So I was then meeting with someone who's now become one of our largest LPs, from Accolade Partners. And he told me along the way, he said, this guy, Roger Ehrenberg, may be the best investor I've ever seen. And IA was not a well-known about fund at that point, but was able to get in touch with Roger and developed a little bit of a point of view on how he invested and kind of tried to accumulate some knowledge. And I saw the way that IA constructed its funds. And I think now I know that some of IA Ventures returns were just published in Go's filings that were put out or something that was put on LinkedIn or Twitter the other day. You can see that those are some of the best performing funds over the last 20 years. Like Roger and what he built with IA is truly remarkable. And same thing with USB and the returns that they had, if not even more amazing.
They're amazing. I saw the same slide. Fantastic.
Yeah. And as you look at what those two firms did, immensely concentrated, non-consensus, point of view on where the market is headed before it's there, and getting real ownership at early stage. And so it's not a coincidence that IA's first fund was a $55 million fund that did roughly 15 investments, took double-digit ownership in every single company. That was exactly our playbook in Fund 1. We did 15 investments. We owned double-digit on every single one of them. We took a board seat on almost every single company in that fund. And I think that's been the style that we've wanted to follow. And I love that. So I'm very thankful that that place of fear ended up opening up an opportunity. And as hearing about Roger and hearing about what USB were doing before it was truly broadly known, I felt was a secret that I wanted to lean into. And now I've done it so long that I just can't imagine doing anything else. So
what's a conventional view in venture you think is bullshit?
So I think everyone leans in on power law. And I had someone that was a senior venture capitalist that I got to know pretty early in my venture career. And as I told him I was going to go start a fund, he said, Rick, this is a power law industry and you should invest in 100 companies, find which one that's working the most and plow all your money and resources behind it. And I told him, I thought that was a pretty shitty deal for the other 99. Look, power law outcomes are going to drive, but to assume that we actually know which outcomes are going to be the power law outcomes, even at the Series B stage, I don't know. So yes, power law is an inevitability. It doesn't mean that we have to lean in on it. And I do find that so many VCs are very quick to kill a company before it's actually been able to hit its level of maturity. Imagine if that happened on Figma. We just had Clay announce a massive financing, right? And then you say they didn't have $1 of revenue for the first 6 years of the company or something like that. So sometimes these things take a long time to mature and then they have inflection points. At the same time, there's a bunch of other companies that look like they're rocket ships and then they crater to the earth. So the reality is there is some agency in this game. There's a lot of luck in this game. And I think the best thing a venture capitalists can do is really focus on getting as many high quality shots on net. For us, we really focus on, hey, we want to get great shots on net, get a lot of ownership, and get those companies to the Series B stage. At that Series B stage, I think we have visibility that those companies are going to have outcomes that are going to be profitable and lucrative for us. Can I tell you whether that's going to be a $250 million outcome, a $2.5 billion outcome, or a $25 billion outcome? No. You can look back at where Datadog and some of these other things, and we're at the BCD stage. No one really knew whether that Datadog was going to be the scope and scale of what it is today. But I think we want to get companies to that stage, and then power law is going to take over from there. But I think most VCs, they'll kill that company really, really quickly, rather than it giving it the chance to kind of mature and so forth from there, or they'll plow all their resources into what is hitting irrational exuberance or is overly hot. And I actually think that's a massive mistake.
I'd give that 3 thumbs up if I had them. Last one, you mentioned a blog post recently you collect baseball cards with your son. Are you a newer issue guy or a vintage guy?
So I'll give a little bit of a sappy story here. So like when I was a kid, like I was not the most social creature. Like I like in 8th grade, I weighed as much as I weigh today. So like butt cut, like Kmart clothes, like not that many friends when I was like a teenager. Like I had a little bit of lisp, but like I'm dyslexic, like all sorts. And my grandma did a lot to take care of me. And I remember my grandma, like she passed away. And 18 months ago, she would take me to like baseball card shops. My first movie I ever went to was Sandlot with her. And she was this Boston Irish woman who gave up everything for her family. And so she took care of me and my cousins a bunch when we were growing up. But I just imagine like this 70-year-old woman at the time, like sitting on the ground, like flopping through baseball cards with me. And she knew I was pretty good at numbers. Like, so she would ask me, what was Paul O'Neill's average like in this, and like pick up a baseball card and like do that with me. And, so when she passed away 18 months ago, like I had 2 young kids at that point, and I was thinking about a lot of different things of how I wanted to find more ways to connect with my kids. And someone invited me to some sports thing that, for a show that they were launching called The Golden Touch, and saw all these cool things. And I decided I was going to get into it with my kids. And like I have like all my old school stuff, and I love that as well. But now I will go and do this with my kids. And I live very close to Yankee Stadium. I love going to Yankees games, but like my daughter and my son, like we'll go to minor league baseball games, and they get so excited to meet the players. My he turns 3 next week. My daughter's 5. Yeah. And so she made a sign for her favorite baseball player. Her favorite baseball player is an Aaron Judge. It's a Yankees prospect named Spencer Jones. And so she made a sign for Spencer Jones. Spencer Jones hit a home run that day and like came and like gave my daughter like a big high five afterwards and signed a baseball card for her. And she ended up being able to do the first pitch at a game like that. And I think about that and finding the ability to connect, sitting on that hardwood floor with my grandmother and go through baseball cards and so forth. And then when I see that with my kids, as like my son, who is a big Aaron Judge fan, like going and like holding his Aaron Judge card, like that's like a 30-cent card, like, and just being able to have them have their own kind of heroes, and also the ability to find a linkage between me being this old 40-year-old guy with my 2 kids who bonding over something that feels like so specifically Americana feels really rewarding to me. So look, we'll see whether they want to do it when they're older enough. But right now, like it feels fun to just have like a little hobby with something that feels like New York isn't exactly the safest or like most conventional or place on the planet, but nothing seems less controversial or than collecting little pieces of paper that have baseball players on them with my 2 little kids. And so I've had a lot of fun with it.
Love it. Well, Rick, this is really fun. Thanks for coming on and having this conversation.
Well, thanks for having me, Joe. It's been a delight.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.